Parsons Corporation, Q2 2026. Top-line revenue came in at $1.576 billion, which is a 1% decrease year over year.
Right.
And GAAP diluted EPS is a loss of 14 cents a share. But here is the real kicker. The forward guidance was slashed.
Yeah, aggressively cut.
Fiscal year 2026 revenue guidance was lowered to a range of $6.2 billion to $6.5 billion. That is down from the previous $6.5 to $6.8 billion.
Exactly. And the adjusted EBITDA guidance took a hit too, cut to between $500 million and $560 million.
I mean, on paper, it is the kind of brutal 1-2 punch that sends retail investors scrambling to hit the sell button before the opening bell even rings.
Oh, absolutely. I mean, the initial reaction to a net income loss of $15 million combined with a downward guidance revision is almost always widespread market panic.
Right. You see those headlines and you panic.
You see a massive guidance cut and you immediately assume the core engine of the business is just failing. But digging into the actual SEC filings reveals a completely different narrative. Management is essentially forcing a massive financial reckoning into a single quarter.
Yeah, it looks like a brutal financial spring cleaning.
That is a great way to put it.
Like, imagine you buy a house, and to get it ready for the next decade, you decide to drag every single piece of heavy, broken furniture out to the front yard.
Just toss it all in a dumpster in one afternoon.
Right. It makes a catastrophic, ugly mess on your lawn today, but it completely clears out the house for tomorrow. That is the exact mechanism driving their GAAP numbers this quarter. They are just taking all the pain at once.
And that pile of broken furniture has a very specific price tag attached to it. We're looking at $118 million in charges that have completely warped this quarter's profitability metrics.
$118 million.
Yeah. So to evaluate whether the core business inside Parsons is actually healthy, we have to isolate that $118 million, figure out the mechanics of why management chose to take the hit right now, and then analyze what is left over.
Well, let's break down that trash pile then, because the reported adjusted EBITDA fell off a cliff, dropping 72% to just $42 million.
Right, a massive drop.
But baked into that drop is the $118 million write-down. And looking at the filings, it falls into two separate buckets. There is a $77 million loss tied to programs they are simply planning to divest, what management calls portfolio shaping action.
Portfolio shaping, yeah.
And then there's a $41 million charge on a specific joint venture program, and they attribute that entirely to historic rainfall and the resulting program delays.
Right, so let's take the $77 million divestiture hit first, because that is a really fascinating strategic maneuver. I mean, in the engineering sector, companies often hold on to underperforming contracts for years just to maintain top-line revenue volume.
Right. It looks good on a headline to say you manage a massive portfolio.
Exactly. Even if parts of that portfolio are bleeding cash and just dragging down operational efficiency. But Parsons is actively choosing to cut loose those non-core, low-margin contracts.
They are stopping the bleed.
Yeah, they are prioritizing profitable, sustainable growth over vanity metrics. Taking a $77 million loss in a single quarter is, well, it's a bitter pill for shareholders to swallow. But the underlying mechanism is entirely defensive. They are permanently stopping the bleed on projects that drag down their overall margin profile.
I mean, ripping the Band-Aid off makes logical sense for the divestitures. You identify the dead weight, you take the write-down, update your spreadsheet, and you move on.
Right.
But that second bucket, the $41 million weather-related joint venture charge, that gives me serious pause.
Really? Why is that?
Well, it is so easy for management to wave their hands and write off $118 million as a one-time portfolio adjustment, but a $41 million hit because it rained too much. That highlights a recurring structural risk for anyone investing in the space.
Ah, I see what you mean.
We are talking about fixed-price infrastructure projects. You cannot divest the weather.
No, you can't.
Yeah.
And that structural risk is actually the defining characteristic of the engineering and construction sector. The mechanics of a fixed-price contract are just completely unforgiving.
Right, because the customer pays a flat rate.
Exactly. When a firm like Parsons signs one of these agreements, they assume the execution risk. The customer agrees to pay a set amount regardless of how long the project takes or what happens on the ground.
Which means if historical rainfall floods the site and delays the timeline by 3 months, your revenue ceiling is completely static.
The revenue doesn't budge.
But your costs, like the daily wages of the specialized labor, the rental fees for heavy equipment, holding costs for raw materials, all of those expenses just keep accumulating every single day the site is shut down.
Yeah, so the margin gets compressed from the bottom up. The longer the delay lasts, the closer those accumulating daily costs get to that fixed revenue ceiling. And eventually, they cross, and the margin inverts into a deficit.
And in this specific joint venture, it inverted into a $41 million deficit.
Exactly. Which highlights a crucial question for anyone evaluating the stock. How much of the remaining backlog carries this specific type of fixed price execution risk?
Well, the company explicitly noted in the filings that they experienced lower volumes on fixed-price commercial contracts this quarter, which diluted overall margins.
Right, and while management treats this specific joint venture hit as an isolated, non-normalized event, the mechanism of fixed price risk is always present. I mean, anytime physical infrastructure collides with unpredictable climate events, you have that risk.
So as an investor, you have to be incredibly careful not to blindly accept normalized numbers without looking at the cash flow. Because when we look at their normalized adjusted EBITDA, which strips away those portfolio actions and the weather-battered joint venture, it actually increased 8% to $161 million.
Yeah, that was great on paper.
And the normalized adjusted EBITDA margin expanded 70 basis points to 10.1%, which sounds fantastic on an earnings call, but that $41 million joint venture charge is real cash out the door.
Oh, absolutely. Normalization is simply a tool to understand the forward run rate of the healthy parts of the business. But the GAAP numbers reflect the historical reality of the bank account. They actually lost that money.
They wrote the check.
Right. But the bet management is making is that by absorbing the divestment costs and the joint venture hit today, the portfolio that remains is de-risked and structurally aligned for higher future profitability.
Right, because that 70 basis point margin expansion on the core business means for every $100 of revenue they bring in, they keep an extra 70 cents of profit compared to the previous year.
Exactly. And at a scale of 1.5 billion in quarterly revenue, those fractions of a percent translate into millions of dollars in sustained recurring cash flow moving forward.
Okay, so if we accept that the $118 million charge is just the painful cost of clearing the board, we need to look at what is actually left inside the house.
The core segments.
Right, the operational performance of the two main segments driving this company, Federal Solutions and Critical Infrastructure. And they tell a very bifurcated story.
Extremely bifurcated, yeah.
Federal Solutions revenue came in at $761 million, which is down 6%. Adjusted EBITDA for the segment was actually a loss of $14 million. Now, I initially assumed this was just general government budget tightening, but digging into the filings, it looks like a specific Department of State reorganization from May 2025 is still dragging them down.
It's still haunting them, yeah.
It seems absurd that they are still bleeding from a bureaucratic reshuffle that happened well over a year ago.
I know it sounds crazy, but the long tail of government contracting is notorious for this exact dynamic.
Yeah.
When you deal with massive federal agencies, budget volatility and structural reorganizations are just systemic risks contractors have to absorb.
They just have to eat it.
Yeah, the funding flows change, strategic priorities shift, and revenue volume drops almost immediately.
It is basically a massive plumbing issue. The money, the water is still sitting there in the congressional reservoir, but the Department of State decided to rip out all the pipes and agencies to replace them with a new system.
That's a perfect analogy.
And until that new plumbing is fully installed, approved, and tested, not a single drop of funding is going to reach the contractor's faucet. Parsons just has to sit there with an empty bucket, absorbing the overhead costs of their cleared personnel until the new structure starts issuing task orders again.
And that overhead absorption is the exact mechanism that destroys margins during a delay. I mean, you cannot just lay off highly trained personnel with top-secret government clearances just because a contract pauses for 6 months.
Right, because getting those clearances takes forever.
Exactly. You have to keep them on the payroll to maintain readiness, which severely drags down segment profitability. But, the contrast provided by their other segment, Critical Infrastructure, is striking.
Oh, it is a completely different climate across the hall. Critical Infrastructure revenue was $815 million, up 5%. Organic growth was 4%.
And the geography there is key.
Yeah, the standout geographic driver here is the Middle East market. Looking at the numbers, it is single-handedly keeping the ship balanced while the Federal Solutions segment stalls.
Right, the Middle East is serving as this crucial financial ballast. That specific geography posted 10% organic revenue growth and a 1.1x book-to-bill ratio.
Wow.
Yeah, so when domestic federal headwinds are suppressing your largest reporting segment, having robust international infrastructure demand provides the margin expansion you need to keep the overall enterprise stable.
And we saw that margin expansion. Excluding that weather-related joint venture charge, the Critical Infrastructure segment saw margins expand 140 basis points to 11.9%.
It's huge.
The filings attribute this to higher Parsons labor contributions and that accretive growth in the Middle East. It really proves the value of a diversified business model. When the domestic side stalls, the international side carries the weight.
It perfectly illustrates how large-scale engineering firms manage macroeconomic risk. I
Yeah.
mean, when domestic government spending stalls due to bureaucratic friction or budget battles, international infrastructure spending often operates on entirely different cycle.
Right, they aren't synced up.
Exactly. The accretive growth in one sector subsidizes the temporary stall in the other, which allows the company to maintain overall stability.
But even with the federal solutions stall, the underlying demand isn't actually disappearing. The current revenue is down, but federal bookings were up 51% year over year.
51%, yeah.
So the water in the reservoir is finally starting to flow into the new plumbing.
And that increase in federal bookings is the critical leading indicator for the health of the segment. Because current revenue recognition is suppressed by those legacy reorganizations and write-downs, the most accurate way to gauge the structural health of the company is to analyze what they are actually booking for the future.
They are winning new work at a grammatically faster rate than they are burning through their current stalled contracts.
Exactly.
Which means we need to look at the backlog to see the true trajectory. Total backlog increased 4% to $9.3 billion. And what really stands out to me in this deep dive is that $6.6 billion of that backlog is fully funded.
That's a crucial distinction.
Yeah, in government contracting, funded isn't just an arbitrary ceiling or a polite promise to pay someday. It means the cash has been formally appropriated by the customer and is legally ready to be deployed, which drastically reduces the risk of the contract being canceled.
Right. And looking at the overall company book-to-bill ratio, it's a very healthy 1.2x. This metric is fundamental to understanding long-term growth.
Explain that for a second.
Well, a 1.2x ratio means that for every single dollar of revenue they recognized and billed this quarter, they booked $1.20 in new future contracts.
So the pie is actively growing.
Exactly. Furthermore, they have maintained a trailing 12-month book-to-bill ratio of 1.0 or greater in every single quarter since their IPO in 2019.
That is incredible consistency.
It really is, especially through the massive macroeconomic volatility of the last few years.
So the volume of the wins is impressive, but honestly, the nature of the wins is where the narrative of this company completely shifts. We are moving away from concrete and water treatment and straight into technology.
This is the pivot.
Yeah, they had 5 contract wins over $100 million in Q2. 4 out of those 5 included advanced AI integration. And expanding the lens to the last 3 quarters, 10 of their 13 major contract wins over $100 million feature AI.
Right. Parsons is executing a deliberate, aggressive strategic pivot. They are actively attempting to reposition themselves from a traditional physical infrastructure firm into a disruptive defense tech player.
Okay, I have to step in with some heavy skepticism here.
I figured you might.
I mean, every single company on Wall Street is currently slapping the letters AI onto their earnings releases to squeeze out a valuation bump. We've seen iced tea companies pivot to blockchain, and now every legacy industrial firm claims to be an artificial intelligence pioneer.
It's a valid concern.
So are these genuine complex technology wins for Parsons, or are these just legacy missile defense and hazardous waste contracts wearing a trendy AL disguise?
Look, skepticism is the absolute correct default setting when evaluating defense sector AI claims. The industry is notorious for taking standard, rules-based data analytics and rebranding it as artificial intelligence for marketing purposes.
Right, AI washing.
Exactly. However, the specific contracts Parsons is winning adjust a much higher technical barrier to entry. We're looking at a $514 million extension with the Missile Defense Agency, and U.S. Cyber Command expressing intent to increase the Joint Cyber Hunt Kit contract ceiling to $750 million.
Okay, wait, a joint cyber hunt kit sounds really impressive on a slide deck, but what is the actual mechanism there? What are they physically building and delivering to the military?
So these kits are deployable hardware and software suites used by cyber operators in the field to actively hunt for malicious activity on secure government networks.
Okay.
The mechanism of AI in this context isn't a simple chatbot. It involves utilizing predictive algorithms and machine learning to analyze massive, chaotic streams of network traffic in real time.
So it's pattern recognition on steroids.
Exactly. The system has to identify behavioral anomalies that indicate a sophisticated breach before it fully deploys. And the hardware has to instantly calculate and categorize threats at the edge of the network, rather than sending terabytes of data back to a central server for human review.
Because that would take too long.
Way too long. And similarly, In the missile defense system, AI integration involves processing complex sensor data and instantly calculating multiple trajectory variables to intercept threats. The technical requirements to deliver these solutions reliably to the military are immense.
You know, that massive technical requirement actually explains a glaring anomaly I saw in their cash flow statement. Operating cash flow for Q2 was only 58 million.
Right.
That is a massive drop from the 160 million they generated in the exact same quarter last year. Initially, a cash flow drop like that looks like a massive red flag. But the filings explain they are proactively investing heavy capital into memory and storage inventory for these exact national security products.
Yeah, they are utilizing their balance sheet to physically secure the hardware components required to execute these tech-heavy contracts.
Right.
I mean, you cannot deploy a 750 million cyber hunt kit without the physical edge computing infrastructure to run the software.
And we all know the global supply chain for advanced memory and storage is still pretty unpredictable.
Very unpredictable. So proactively buying that inventory ensures they can actually deliver on the backlog. It temporarily depresses current operating cash flow, but it secures high-margin future revenue.
And the margins validate the strategy. Expanding the normalized adjusted EBITDA margin to 10.1% proves they are delivering real technology value. I mean, traditional pure-play construction firms simply do not command double-digit margins.
No, they don't.
You only get those margins when you transition from manual labor and fixed-price concrete pouring to deploying proprietary hardware and software solutions at scale.
Which brings us back to the overarching narrative for retail investors. Management is basically demanding patience in exchange for a cleaner, more profitable future. They recognize that carrying low-margin, high-risk contracts was dragging down the valuation and stalling their pivot into defense tech. So by slashing the FY26 guidance and absorbing $118 million in portfolio shaping and weather-related charges today, they are attempting to reset the baseline.
They threw out the broken furniture so the house is ready for the new tech installations. The 9.3 billion backlog, the 51% jump in federal bookings, and the relentless 1.2x book-to-bill ratio. I mean, those are the receipts they're showing investors to prove the core engine is not just resilient, but actively accelerating.
Exactly.
You are paying for the ugly JAP numbers today to own a highly specialized, de-risked portfolio tomorrow.
And, you know, the transition Parsons is attempting brings up a really fascinating industry-wide question for you to mull over. We were observing a legacy engineering firm aggressively weaving artificial intelligence and cyber hardware into its core revenue stream.
Which is a huge shift.
It is. As our physical infrastructure, our power grids, our municipal water systems, our global defense networks, as all that increasingly merges with edge computing and cybersecurity, the traditional boundaries of the sector are dissolving.
Right.
When a concrete bridge requires an embedded neural network to monitor its structural integrity in real time, or a military base requires deployable cyber hunt kits to function, will the market eventually be forced to reevaluate these legacy engineering firms as pure-play technology companies?
That is the big question.
Yeah, because the line between building the physical world and coding the digital one is rapidly disappearing.
Follow the show for your daily earnings coverage.